This has got to be the most bearish report that I have read on the US stock market and US economy, quite frankly, in many months. This is somewhat shocking, and I still haven't exactly figured out how to adjust my own beliefs around this. 2.5 weeks or so ago, I moved to about a 6 on the bullish scale. 10's like all in margin, 1's like all cash. I went to about a 6, still never got out of that mid-range, but this... Don't know yet how this is going to affect things. Look at this, folks. Citi. The U.S. economy is clearly slowing down, and in our base case, it is headed for an outright contraction. That's a recession, mind you. Consumer spending declined 0.1% month over month in April after Q1 data were revised down to show a more dramatic decline in real goods spending. Core PCE inflation slowed, still elevated, but enough of a slowdown to keep the Fed on track to cut later this year, even if hiring holds up better than we expect, which they don't. They actually think hiring and the jobs market will deteriorate so severely that the Federal Reserve will cut 25 basis points in July, not because they want to, but because they have to, and that they'll end up cutting 200 basis points in the subsequent 8 meetings. Yikes. Okay, let's take a look at this. For the last 2 years, the U.S. economy has been resilient, defying forecasts of a slowdown. But the cycle finally appears to be turning. A pullback in consumer spending, slowing inflation, pricing power rapidly dissipating. Oh, nobody likes small PP. And a projected significant softening in the labor market is keeping us projecting the first cut in July. Now, I want you to remember how, in terms of pattern, these things work. People say, oh, but the consumer is still spending. Why does the consumer still spend? I want you to ask this of yourself. Do you know a friend or a family member or whatever who, I don't know, just spent a bunch of money on a new house, right? Think about this. New house or new car, new fancy clothing, new vacation, whatever it is. Were those people with substantial wealth? Like, did they come from having a lot of money? Did they have a lot of investments or something? Maybe not. Let's say the not scenario, they just happen to be able to afford all this stuff. Why are they able to spend so much money on all this extra stuff? There has to be a reason. Yes, there's a very simple reason for this, and that is that the jobs market is still decent enough. People still earned substantial raises over the last few years, made substantially more money, wage inflation was significantly high. But what happens first, friends? What happens first? Do people lose their jobs and then stop spending? Or do people stop spending because we're going into a recession and then they lose their jobs because of the velocity of money? Oh, less people are spending. I guess now we're going to have to lay people off. Well, to some extent, you could argue both ways, but for the vast majority of people, specifically Americans, I would argue that as long as people have their jobs and they have confidence in their jobs, they keep spending. But as soon as that confidence goes away or their job goes away or they get laid off, all the spending goes away. So looking at retail sales data and consumer spending data is even more lagging of an indicator in America than the jobs market. Okay, so what else do we have here? The economy has been overheating since 2021. The tailwinds to consumer spending have faded, particularly for the lower income and lower net worth. Credit card delinquency rates by some measures are at their highest levels on screen here since 2007. And interest expense as outside of mortgages is at the highest levels excuse me, that we've seen since, quite frankly, anywhere on this chart. Rent as a percentage of disposable income is rising to some of the highest levels that we've seen since the period right after the Great Recession. And Citi goes as far as saying that goods spending is already in outright contraction. They say Q1 real goods spending was revised lower. April is showing another decline. Services spending supported consumption in Q1, but April real services slowed to just 0.1% month over month in April. Very, very, very slow. And cyclically sensitive spending on restaurants is usually followed by good spending, has declined 4 out of the last 5 months. In other words, we're starting to see a flip. And consumer spending will pull back more sharply if the labor market weakens more sharply. And there are already signs in survey data that individuals are becoming more concerned. Take a look at this chart. The blue line, which has a line going down, those are the odds of you finding a new job if you lost your job today. And the light blue line going up, those are the odds that people think they're going to lose their job over the next 12 months. Yikes. That fear alone could reduce spending. And Citibank says, look, right now you might be seeing a slowing in the labor market, but let's be real. When the economy actually flips, it's not going to be a slowing anymore. I'll read you what they wrote and then I'll translate it. At some point, there will be a non-linearity where firms economize on labor through outright layoffs rather than through slower hiring. The risks remain sharply to the downside. Okay, so what does that mean in English? In English, hey y'all, we might be slowing down hiring right now, but when poop hits the fan, we just gonna fire everyone. It's gonna go fast, in other words. Yikes. Yikes. This is unemployment rate expected to rise to 4%. Consistent with that, and they expect that the Fed's going to move to 2 rate cuts. So they're going to keep sort of pressure on. Remember that American Airlines just guided weak summer travel. They expect to see a further slowdown in leisure and construction, especially less seasonal hiring into the summer. Almost all the data that they're looking at is starting to roll over, especially, they say, that sensitive summer and seasonal data. And they say that they do give a quick election update, and they say that Donald Trump has a little bit of a lead. But on top of the election update, they say, we suspect slowing job growth in May will largely reflect weaker hiring in sectors where employment typically increases into the summer. The trend of job growth in leisure and hospitality has already slowed, in line with softer spending at restaurants. After running consistently at a 20 to 50K pace for the previous 12 months, we saw it fall for the first time in April since 2020. And construction employment could also start to decline as the demand for housing remains weak. In other words, really sensitive portions of the economy are going to start rolling over very dramatically and very quickly. This is scary. And quite frankly, jobs market rolls, the Federal Reserve is going to be forced to flip very rapidly on this economy. And unfortunately, if they start cutting rates a little bit at a time and it comes too late, well, then you're already in a recession. In fact, Bloomberg economists just yesterday reported the government is likely overstating the jobs they created in 2023 by 1 million jobs. In fact, they referenced October 2023's job data, and they said that they can't rule out that a recession began in October of 2023. But they said we won't know for certain until revisions come out just before the election in August. Yikes. That means half of all the jobs we thought we had might just be fugazi numbers. Now, I mean, color me shocked, okay? Government data being a little botched. But let's also consider this. The closing of the border to migrants and asylum seekers. Less people going to show up in the jobs numbers. So you got a lot of things going against you. Potentially overstated numbers, the border being shut down, which I understand people want that anyway, but it also contributes to lower employment numbers. Yes, they show up in government employment numbers. And what Citi's here saying? Folks, this is starting to make me nervous. Yikes. What do you think? Let me know in the comments down below. And if you need life insurance in as little as 5 minutes, go to metkevin.com/life, paid sponsorship, and check out the courses on building your wealth, link down below. So this is exactly what we've been talking about. A slowing coming. The ADP report showing us, look at this. Job gains, it's starting. This report out minutes ago. Job gains were slower in May due to a steep decline in manufacturing. Leisure and hospitality also showed weaker hiring. This is exactly what some banks are starting to warn of as the start of, I hate to say it, but a recessionary slowdown. People are like, wait, but things are supposed to be getting better, right? We're supposed to be coming out of a hole. And that's what I've been wanting to think after all these wonderful, spectacular earnings. But again, earnings are driven by spending, but spending really halts once people lose their job or you go into recession, or both, quite frankly. Look at this. This is the S&P Global U.S. Manufacturing PMI. So initially, we're like, yay, new orders returned to growth in the U.S. in May, supporting faster expansion and growth into the second quarter. If you only read the first few lines, you'd be like, that's great. Meanwhile, business confidence picked up and positive expectations regarding the future for continued hiring, renewed rise in purchasing activity, and a buildup of stock of finished goods. Blah, 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 blah. That's great. Okay, wonderful. So good news here on manufacturing, right? Oh, but wait, let's get into some more of the details. Input cost inflation quickened to the fastest rate in over a year. Cool. So if you have a slowdown and inflation, that's stagflation, right? That's not good. Okay, what about this? When we saw a renewed expansion of orders following a modest reduction in April, but what's this here? While demand improved during the month, overall economic conditions remained muted. The rate of expansion was only marginal. In fact, the rise in total new business was softer than that seen for the new export reports or new export orders, which increased at the fastest pace in 2 years. Firms reported signs of improving demand in Europe alongside growth in Asia, Canada, and Mexico. Okay, so good news on that export, but weaker than expected in the US. Increase in new orders alongside better material availability led manufacturers to expand production at a solid pace in May. That's good. Firms were also confident that production will rise over the coming year, thanks to optimism that renewed expansion in new orders will be sustained in the months ahead. Plans to increase capacity also contributed to positive sentiment. Okay, so far it's kind of mixed, right? I mean, it's mostly good, a couple little bad lines there. Okay, great. What is this? Employment increased for the 5th consecutive month at the fastest pace since July 2023. Great. Higher staffing levels reflected the filling of previously vacant positions. Meanwhile, the rise in purchasing activity was the first in 3 months, but only marginal. The expansion in input buying was not sufficient to prevent a further reduction in the stock of purchases. But it at least restricted the pace of depletion to the weakest in the current 3-month sequence of falling inventories. In other words, companies just aren't needing as much product. Stock of finished goods, on the other hand, increased for the second month running. Expansion to capacity and recent muted demand conditions meant manufacturers continued to lower their backlogs of work. The pace of depletion was slight, however, and the weakest since February. The rate of input cost inflation continued to accelerate, quickening for the 3rd consecutive month to the fastest since April of 23. The latest increase was also sharper than the pre-pandemic average. Higher costs for aluminum and copper in particular, and metals more generally were reported, as were increases for fuel costs. So, kind of a little bit of a mixed bag, huh? So, you're seeing a return to growth following a blip in April, although modest, the expansion of new work bodes well in the coming months. Okay, so this is, it's like trying to be optimistic, I guess, so we'll color that yellow here. And manufacturers cited confidence, but you're seeing that stagflation potentially come alongside a slowing in the expansion of consumption. So think about that for a moment. It's kind of it's a nasty cycle. If consumption goes down while manufacturing is still going up for now, but input costs are going up, what happens when that consumption finally turns over to lower manufacturing while at the same time you have lower input costs? It's a stagflationary kind of recession. It's not great. And that ADP report we just got, unfortunately, contributes to this. Remember, they said a lot of the jobs filling that they did was just filling vacant positions. But once those vacant positions are filled, now they're full. Now you don't have room anymore for new people. It's interesting. It's not like a major red flag on the manufacturing side, but what it is, it's almost like you're starting to see some cracks, and the whole story is starting to connect a little bit better together, that things are slowing down, or at least there are some signs of red flags. Let's look at this a little more. So goods producing negative 9,000, construction 32K, that's actually still pretty decent. Manufacturing 20K, IT negative 7K, financial activities 28, 55 over here. Where's leisure hospitality? This right here, 12,000 leisure hospitality, that's low. You're usually between 20 to 50K on this number. So you're starting to see this rollover, and we're not even in the summer yet, when you're seeing companies like American Airlines say, maybe our bookings won't be as great as we thought. It's kind of interesting. And then, of course, you get some regional changes here. Small establishments down 10,000, medium up 79, large up 98. So you still have growth, obviously. This over 150K number is still decent. Those job changer pay numbers are finally falling down again from that 9%, which was crazy that we saw for a moment. But remember, Jerome Powell cast water on the idea that he was really nervous about a wage price spiral anyway. I think the biggest thing the Fed's now concerned about is that potential jobs and labor market recession rolling over. Now, of course, you have people on the internet saying, no, there's no recession now. There's no recession. There's not going to be a recession in 24. There's not going to be a recession in 25. There are some economists, which we know, economists have predicted 12 out of the last 2 recessions. But there are some who say, statistically, depending on how the numbers come in with jobs, a recession may have actually started in October of 2023. Yeah, that's crazy. So we'll see. We'll see. But anyway, that gives us a little update on the good old jobs data. And it just contributes to some of the fears of banks like Citigroup.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.